Good day everyone, we are Group 2. Today we will be presenting a financial performance analysis of 6 companies listed on Bursa Malaysia within the consumer products and agro-food industry. This presentation is prepared mainly for potential investors. Our aim is to evaluate the financial strength, business risk, and investment potential of each company by analysis their financial statements and key financial ratios. Companies our group analysed that list on Bursa Malaysia are Nestle Malaysia Berhad, Dutch Lady Milk Industries Berhad, Farm Fresh Berhad, Fraser and Neef Holdings Berhad, Hub Sang Industry Berhad, and QL Resources Berhad. The objective of this presentation are to analysis and compare the financial performance of 6 selected companies over 2 financial years. First, we will briefly explain the background of each company to understand their business nature. Next, we will conduct a SWOT analysis to identify the key strengths, weaknesses, opportunities, and threats faced by these companies. We will then perform common size analysis for both the income statement and balance sheets, followed by financial ratio analysis. Finally, based on all findings, we will provide an overall investment recommendation.
This slide summarizes the background of the 6 company analyzed. Nestle Malaysia is a global FMCG leader with strong brand recognition and premium product. Dutch Lady Milk Industry is an established dairy producer with a long operation history. Farm Fresh Berhad is fast growing local dairy company focused on expansion and market growth. Fraser and Neef Holdings or FN is a diversified of food and beverage group. Sang Industry focused mainly on biscuit manufacturing with a traditional business model. While QR Resources is an integrated agro-food group with operation across several segments. Although they operate in the same industry, their business strategy and growth stage are different. This slide presents the overall SWOT analysis for the companies. In terms of strengths, all companies benefit from strong brand presence and stable consumer demand as food products are distinct items. However, common weaknesses include high operation and raw material costs, as well as exposure to foreign exchange risk. Opportunities mainly come from the increased demand for health-concerned products and potential regional expansion. On the other hand, threats include intense competition, resist cost, and regulatory challenges, which may affect profitability and growth.
Now we are going to discuss about common size balance sheet. So in this common size balance sheet shows how each company common structures its assets and financing as a percentage of total assets. Nestle and QL Resources have a high proportion of property, plant and equipment, indicating capital-intensive operations. Secondly, Farm Fresh also shows higher assets due to expansion activities. And thirdly, F&N and Cooksing demonstrate stronger equity position with lower liabilities, reflecting better financial stability. In contrast, Nestle relies more on liabilities, which increase its long-term financial risk. Let's discuss about common size income statement. The common size income statement allows us to compare cost structure and profitability across companies. Cooksing the highest efficiency with lower cost and higher net margins. Farm Fresh showing improving profitability as revenue increases, although costs remain moderate due to expansion. And thirdly, F&N and QL Resources maintains relatively stable performance. Nestle and Dutch Lady experience margin pressure caused by higher operating and production costs. This analysis highlights the importance of cost control in maintaining profitability.
I am going to explain about liquidity analysis. Liquidity ratios measures a company's ability to meet its short-term obligations using current assets. From the table, Farm Fresh record the strongest liquidity position with the current ratio of 2.57 and quick ratio of 1.74. This indicates that the company has more than sufficient liquid assets to cover its short-term liabilities. FNN and Hub Seng also show healthy liquidity levels, with both ratios have above 1. This suggests good working capital management and lower short-term financial risk. In contrast, Nestle and Dutch Lady have current and quick ratios below 1. This indicates tighter liquidity cushion, meaning they may rely more on short-term financing to meet obligations, which increase short-term financial risk. Overall, companies with stronger liquidity are better positioned to handle unexpected cash pressures. Solvency and debt analysis. Solvency ratios evaluate a company's long-term financial stability and its reliance on debt financing. Nestle has the highest debt ratio and a very high debt to equity ratio of 5.67 times. This indicates heavy reliance on borrowings, which increase financial risk, especially during economic downturns. Dutch Lady shows moderate leverage, while Farm Fresh maintain a balanced capital structure, reflecting a mix of growth financing and financial control. FNN and Ahab Singh demonstrate the lowest leverage among the companies, indicating conservative financing strategies and stronger long-term financial stability. QL Resources also maintain a reasonable level of debt, suitable for supporting long-term expansion. Overall, companies with lower leverage are generally less risky for long-term investors.
These ratios measure how efficiently companies manage their inventory and collect receivables. Hubsense records the shortest inventory period at 42.17 days, indicating efficient inventory management and strong demand for its products. Nestle and QL also maintain relatively efficient inventory cycles, reflecting effective operational control. Farm Fresh shows the longest inventory and collection period. This is common for fast-growing companies as expansion often requires holding higher inventory levels and offering longer credit terms to grow market share. Overall, efficient asset management improves cash flow and reduces operational risk, which is important for sustaining long-term profitability. Profitability ratios measure a company's ability to generate profit from sales and assets. Hubseng records the strongest performance with the highest net profit margin of 14.57% and return on assets of 22.95%, reflecting excellent cost control and efficient asset usage. Farm Fresh and FNN also perform well with the net profit margins above 10%, indicating strong operational performance. Nestle and Dutch Lady report lower profitability mainly due to higher operating and production costs, which reduce margins. Overall, higher profitability signals better efficiency and stronger returns on investors.
My name is Leon and my matric number is 306123. Now I'm going to present the slide for the market value and investor view. Market value ratios reflect how investors perceive a company's future earning potential. Nestle has the highest PE ratio at 56.41, indicating strong brand confidence but also suggesting that the stock may be overvalued relative to its earnings. Farm Fresh and QL Resources also trade at higher PE ratios, reflecting growth expectations from investors. In contrast, Hubseng and Dutch Lady have lower PE ratios, which may indicate undervaluation or lower growth expectation. Investors often compare PE ratios together with profitability and risk to determine whether a stock is fairly priced. Based on the overall financial analysis, Hubseng Industry Berhad is our top recommendation. This is due to its strong profitability, efficient asset management, solid liquidity, and relatively low market valuation. Farm Fresh Berhad is recommended as a growth investment. While it carries higher risk due to expansion and longer operating cycles, it offers strong growth potential. QL Resources and